$0.50 more by selling shares of ownership in Facebook to rich investors. The plan does not include a public stock offering, at least not right now. For now, Facebook would remain a private company, meaning a company that does not sell shares to the public. The plan has brought new attention to the largely secretive world of private financing and the rules for private companies in the United States. The idea is that investors in public companies have protections that investors in private companies do not. The Securities and Exchange Commission says a private company must report financial information if it has more than 500 shareholders. A new business, a startup company, is usually considered too risky for average investors. But a promising startup may find a small number of private investors, often known as angels. These investors are willing to lose everything for a chance at big returns. Rikki Tata has been involved in raising money for startups. He is now chairman of his own investment company, Covestor, with offices in New York and London. Mr. Tata compares the difference between public and private companies to the difference between marriage and dating. When people are dating, he says, there are understandings, but few rules. In marriage, the rules are more clear and well-defined. In his opinion, the only real benefit for a private company is lower administrative and record-keeping costs. Yet, he tells us Covestor remains a private company after a few years because it is still too risky for most investors. For VOA Special English, I'm Alex Villarreal. You can comment on our programs and find transcripts and MP3s at voaspecialenglish.com. We're on Facebook and Twitter at VOA Learning English. This is the VOA Special English Economics Report. Facebook is the world's biggest social network. It has over 900 million users worldwide, and it reported $3.7 billion in sales for last year. The company has been privately held since 2004. That was when Mark Zuckerberg and several classmates at Harvard University started Facebook as a business. But on May 18th, Facebook becomes a publicly traded company. That means its shares will be listed on the NASDAQ stock market and sold to the public. Interest in the stock kept building after Facebook announced details of its initial public offering, or IPO, earlier this year. The IPO will make billionaires of the company's founders, including Mr. Zuckerberg. Eduardo Saverin, a Brazilian-born co-founder, has been strongly criticized for recently giving up his United States citizenship. By doing so, he will avoid a 15% tax on the value of his shares. He now lives in Singapore. Shortly before the trading started, Facebook told the Securities and Exchange Commission that it wanted to increase the number of shares being offered to over 420 million. The company had earlier said it planned to offer 337 million. The starting price was set at $38. Also, an increase. Some financial experts say Facebook could raise $16 billion, making it one of the biggest IPOs ever. Most of Facebook's revenue comes from online advertising. But the company also says it expects to earn money from fees charged on the sales of virtual goods. These are digital products used in social games, not physical goods. Facebook says it sees important income coming from this new market, which could reach $14 billion by 2016. Not everyone is pleased. General Motors ended its advertising agreement with Facebook just before the stock began trading. The car maker said it did not see results from the millions of dollars it spent on advertising with Facebook. And Facebook has been criticized for some recent business decisions. It offered $1 billion to buy Instagram, an application for sharing photographs. The deal requires government approval and has yet to be finalized. So, is Facebook worth the price of the stock? That will be for investors to decide. For VOA Special English, I'm Alex Villarreal. You can read, listen, and learn English with more business stories at voaspecialenglish.com. I'm Alex Villarreal with the VOA Special English Economics Report. The Federal Reserve calls America's economic recovery disappointingly slow. So the Federal Reserve decided to add $600 billion to the financial system by the middle of next year. To do this, the central bank will buy Treasury securities from dealers. The action is known as quantitative easing. The goal is to reduce long-term interest rates. The hope is to create conditions where businesses will invest more and people will spend more. Buying longer-term Treasury securities will make less government debt available to investors. This will raise the price. As bond prices rise, their rates fall. Long-term securities affect rates on home mortgages and other loans. Lower rates on corporate bonds could lead businesses to invest in more equipment and jobs. Lowering short-term interest rates is the Federal Reserve's main way to get banks to increase lending. But those rates are already near zero. The Fed earlier bought $1.75 trillion of treasuries and other securities. That program ended in March. Fed Chairman Ben Bernanke wrote in the Washington Post, "Easier financial conditions will promote economic growth." But interest rates are already low, and critics say further cuts are unlikely to create much growth. Inflation also is low, so low that some economists worry more about the risk of falling prices and wages. But others say pumping more money into the economy will weaken the value of the dollar. They say it could raise inflation to dangerous levels, and not just in America. Interest rates in the United States and Europe are lower than in Asia and Latin America. As a result, Asian and Latin American economies are already struggling with an overflow of investments. Large flows of capital can raise currency values and make export-based economies less competitive. Several nations are considering limits on capital. The Fed's action in November had been expected, but it came as the heads of 20 leading economies prepared for talks in South Korea. And it came a day after the Republican Party retook control of the House of Representatives from the Democrats. President Obama invited leaders of both parties to meet on November 18th. One immediate issue was what to do with tax cuts that are set to end in December. For VOA Special English, I'm Alex Villareal.